Here's something nobody tells you when you open your first savings account. Saving money is not the same as building wealth. And if you've been treating them like they're the same thing, this video is going to change how you think about money forever. Most people do the responsible thing. They put money aside every month. They watch the balance grow. They feel good about it. And then one day they do the math and realize that after a full year of being disciplined and responsible, their savings account paid them enough to cover maybe a tank of gas. Meanwhile, the people who figure out the next step are quietly watching their money do the heavy lifting for them. So what's the next step? That's exactly what we're covering today. The step-by-step path from saving money to actually growing it. No jargon. No complicated strategies. Just the thing most people figure out 10 years too late. Let's get into it. First, let's talk about why saving alone doesn't work the way most people think it does. Saving is protection. That's it. When your money sits in a savings account, it's safe. It doesn't disappear. It doesn't swing up and down. It just sits there, quietly earning somewhere around 0.5% to 1% interest per year if you're lucky. In theory, that sounds fine. In practice, here's the problem. Inflation, the general rise in prices over time, typically runs at around 2 to 3% per year. So if your savings account is paying you 1% while inflation is running at 3%, your money is actually losing purchasing power every single year. You're going backwards while standing completely still. That's the part most people never see coming. Now here's where it gets interesting. Compare that savings account to what happens when money is invested in the stock market. Historically, the S&P 500, which is just an index of 500 major American companies, has returned an average of about 10% per year over long periods of time. Let's put that in real numbers. $10,000 in a savings account at 1% interest. After 20 years, you got roughly $12,000. Not bad. Better than nothing. But now take that same $10,000, invest it at 10% annually, and after 20 years, you're sitting on about $67,000. Same money, same person, completely different outcome. The only thing that changed was a decision of where to put it. This sounds simple. It isn't, because the real barrier between saving and investing isn't math. It's psychology. Saving feels safe because it is safe. You can open your app and see exactly what's there. It doesn't move. It doesn't panic. It doesn't drop 5% on a random Tuesday because some politician said something in a press conference. Investing is different. Investments move. Sometimes they move up and you feel like a genius. Sometimes they move down and you feel like you made the worst decision of your life. And that emotional roller coaster is exactly why most people never make the transition. They know they should invest. They just can't bring themselves to pull the trigger. Here's the good news. You don't have to do it all at once. In fact, you shouldn't. The transition from saving to investing works best when it happens in stages. And if you follow these steps in order, the whole thing becomes a lot less terrifying. Step 1. Build your emergency fund first. And we're talking a real one. 3 to 6 months of actual living expenses, sitting in a savings account, untouched. This is not your investment money. This is your sleep well at night money, job loss money, medical emergency money, car breaks down on the worst possible day money. Here's why this matters more than most people realize. The number one reason people panic and sell their investments at the worst possible time is because they need cash fast. And when you're forced to sell during a market dip, you lock in the losses. Your emergency fund isn't just protecting you from life surprises. It's protecting your investments from yourself. So before you invest a single dollar, make sure that safety net exists. Non-negotiable. Step 2, change how you think about your money. This sounds basic. It's actually crucial. Most people think about their money as one big pile. And when something unexpected comes up, they dip into whatever's available, including money that was supposed to be growing. Start thinking in 2 separate buckets instead. Bucket 1 is your safety money. This is your emergency fund, your short-term savings, money you might need in the next 1 to 3 years. It doesn't move. It doesn't take risks. Its only job is to be there when you need it. Bucket 2 is your growth money. This money has one job, and that job is to grow over time. It's allowed to fluctuate. You expect it to go up and down. And because you've already got bucket one covered, you don't panic when bucket two is a rough quarter. That mental separation alone removes a massive amount of investing anxiety. You know the type of person who checks their investment account every single day and stresses about every little dip? That's someone who never separated their buckets properly. Step 3. Start small. Seriously, embarrassingly small if you have to. A lot of people wait to start investing because they think they need a significant amount of money to make it worth it. They're waiting until they have $5,000 or $10,000, or until the market looks more stable, or until the timing feels right. Here's the thing. The timing never feels right, and the amount doesn't matter nearly as much as the habit. Most brokerage platforms today let you start with as little as $50 or $100. The point isn't to get rich in the first month. The point is to get comfortable with the process, to watch your investment account move up and down without having a heart attack about it, to build a muscle memory of being an investor. Small, consistent action beats waiting for perfect conditions every single time. Step 4. Keep your investments boring, at least at first. This is where beginners tend to go off the rails. They start researching investing and suddenly they're reading about options trading, leveraged ETFs, crypto altcoins, and some stock that's supposedly about to go to the moon. And before they've even opened a proper investment account, they've convinced themselves they need to be doing something complicated. You don't. In practice, the simplest investment strategy has consistently beaten most complicated ones over long periods of time. It's called an index fund. And here's how it works. Instead of picking individual companies and betting that they'll outperform the market, an index fund lets you invest in hundreds of companies at once. You're not trying to win. You're just not losing to the market because you are the market. Warren Buffett, arguably the greatest investor of all time, has repeatedly said that low-cost index funds are the best choice for most investors. Not hedge funds, not day trading. Index funds. If that's good enough advice for him to give, it's worth taking seriously. Step 5. Let time do the heavy lifting. Here's a quick example that should make this very real. Imagine you invest $300 a month into a simple index fund. The market averages 8% per year, which is a conservative estimate. After 25 years, you've contributed $90,000 of your own money. But your account doesn't have $90,000 in it. It has around $285,000. Nearly $200,000 appeared. Not because you work harder, but because you left your money alone long enough for compounding to work. Compounding is just the idea that your returns start earning their own returns. And the longer you leave it alone, the more powerful it gets. It doesn't look impressive in year 1. It starts looking ridiculous around year 15 or 20. The analogy that actually makes sense here is seeds. Saving money is like storing seeds in a jar. They're safe, they're protected, they're all still there, but nothing's growing. Investing is like planting those seeds in soil. It looks messy at first. You don't see anything happening. But given enough time, you end up with something that couldn't fit back in the jar. Now, before you go, I want to address the question almost everyone has. What happens if I start investing and the market crashes? First of all, it will. Not might. Will. Market crashes are a completely normal part of how this works. They've happened dozens of times throughout history. And every single time, markets have eventually recovered and gone on to hit new highs. But here's the part that surprises most people. If you're investing consistently every month, a market crash is actually an opportunity. Because when prices drop, your monthly investment buys more shares at lower prices. You're getting more for the same money. And when the market eventually recovers, and historically it always has, those cheap shares are worth a lot more than you paid for them. Long-term investors don't panic during downturns. They stay calm because they're thinking in decades, not days. So let's bring this back to where we started. You saved money. You did the responsible thing. But you realize that responsible and strategic aren't the same thing. Because saving gives you stability, but investing gives you freedom. And the gap between the person who figures that out at 25 and the person who figures it out at 45 is measured in hundreds of thousands of dollars and decades of compounding they'll never get back. The path isn't complicated. Emergency fund first. Separate your safety money from your growth money. Start small and start now. Keep it simple with index funds. Then stay consistent long enough for the math to work in your favor. The people who build real wealth aren't necessarily the ones who make the most money. They're the ones who figured out earlier that their savings account was never going to get them there. If this clicked for you, hit subscribe because this is exactly the kind of thing we break down here. And I want to know, are you still in the saving stage or have you already started investing? Drop it in the comments. The answer might surprise you.